Investing, stock market, PE ratios, dividends, blue chip stocks, Dogecoin. You have probably heard of one of these in the past year or so, or have been hearing about some of these ever since you become an adult. You were probably told a bunch of unoriginal, pleasant sounding phrases like pay yourself first, save at least 10% of your income, and don't spend it all in one place. Are all these people just NPCs trying to add dialogue to our lives, while we still aim to complete the main goal of slaying the grand dragon and become the king of the castle? Or do these people actually mean well? Well, although some of those people might be NPCs, I believe they are giving some pretty decent advice. But if they were to give you more context and actionable steps on how to actually achieve wealth, then it would be more useful. Welcome again to my humble channel. I am Stannis and I talk about financial related topics. Today I'm going to take a closer look into some different investment styles that you can pursue in 2023 and reveal the negatives and the cons of each style. Keep in mind, you do not have to be any of these type of investors, or you can be a mixture of all of them. It really depends on what your goals are. The first type of investor is the dividend investor. These investors hold stocks that give a dividend. Dividends are a sum of money paid regularly, typically quarterly, by a company to its shareholders out of its profits or reserves. The reasons they enjoy dividend stocks are over other forms of investing is because they get paid out a certain amount of money each quarter, biannually, or in other timely manner that is dependent on the stock itself. With this expected income, investors can live off their investments quite easily. When you reach a certain amount of holdings in a company, the dividend income can start to replace your primary means of earning money or just add to it. One of the drawbacks about this method is about the dividend income takes a lot of capital to make a generous amount of money. For example, to make $1,000 off of a stock with a 4% dividend yield within a year, you would need to own $25,000 worth of that company. That's a lot of money, and it would take a lot of time to reach that amount of savings. And some people might argue that $25,000 can bring a lot of joy in one's life, but having income in from nothing but your own savings is quite euphoric to me. So I think dividend investing is pretty solid. When dividends hit your account, you will have the option to either pull out the money or reinvest what you have earned and continue to put money into the company, thereby snowballing your potential returns if the price of your stock continues to increase in value. If you're younger and you don't plan on using the dividend income on any other venture, then I think reinvesting back into the company is a pretty solid move. If you do happen to be older and perhaps rely on the income, then it is understandable on why you would want to use your profit. Do not forget you will also have to pay taxes on these since it is considered income, but talk to a CPA for more information on that. Some stocks will offer very high dividend yields to attempt to make their stock more appealing to the public. Do keep in mind that a dividend yield above 5% might become a stock that fails to innovate, leading to a collapse and eventually cutting their dividend. Dividends are the most beneficial when you can get appreciation on the asset itself while also getting a dividend. The thing is that a dividend stock can also decrease in value, but you will still get paid at the stock's certain interval if they maintain their dividend. Now this is a big deal because during bear markets, you will continue to get paid even though the stock itself might decrease in value. If you are worried that the dividend stock you choose will move their dividend, then you can look at dividend aristocrats, which have paid increasing dividends for at least 25 years in a row, or dividend kings, which have increases by at least 50 years. For the majority of these options, they will continue to keep their dividend and even increase it over time. The dividend investor is very patient and he or she will greatly benefit from their hard work by not having to do any real work besides withdraw their money. They are more long-term thinking than most and are focused on becoming financially free from having to work. Most people begin with humble returns from dividends, but if you give it enough time and resources, it will begin to produce a decent amount of money for you. The under the mattress saver. You might think I'm joking about this one, but this is somebody's reality, and the fact that I'm calling it out right now is freaking them out. Back in the day, I used to be a mattress saver, but that was before I had a bank account to my name, and I started to learn more about personal finance. I thought it was pretty clever until I realized a lot of people do the exact same thing, therefore making this clever idea quite mediocre. Keeping a great amount of money in your possession or hidden within your home is not the best way to protect your money, especially since 1 million burglaries happen a year in the US. You can always get a safe and have it at your home, but I do believe the best option is having a bank account, so they can hold your money and at least you'll earn some interest on it, even though it's not that much. Most people who save their money this this way are most likely uneducated about their options for wealth sustainability, or they do not trust the establishment in its entirety and prefer to maintain full custody of their assets. In my humble opinion, if you are going to continue this method, I would be a little more creative about your storage location as of 2023. These people are going to lose money due to inflation more than the average savings account holder. The mutual funds or ETF investor. Mutual funds let you pool your money with other investors to mutually buy stocks, bonds, and other investments. They're run by professional money managers who decide which securities to buy, stocks, bonds, etc., and when to sell them. You get exposure to all the investments in the fund and any income they generate. This method is quite passive and may only require some time up front, so you can establish your own personal goals and discuss your risk tolerance with the fund's manager. Typically, the expense ratio will be around 0.5 to 1%. This expense might seem small right now, but over time, this expense will eat away at your profits. ETFs or exchange-traded funds are exactly the same. Implies funds that trade on exchanges generally tracking a specific index. When you invest in an ETF, you get a bundle of assets you can buy and sell during market hours, potentially lowering your risk and exposure while helping to diversify your portfolio. There are a great amount of ETFs in the market to buy, so you can find one that matches your interest. ETFs can be personally managed or not. Thereby leading to smaller expense ratios, usually around 0.2%. But once again, these expense ratios will eat away at your profits, so it's important to find low expense ratios like Vanguard Stock Market ETF, which has a 0.03% expense ratio. If you're brand new to investing, you have no idea what to initially invest into, then the ETF might do the trick initially. ETFs will allow you to be diversified in the market you decide to buy in, and it will be easily tradable since you can trade them during the market hours of the day. ETFs are also very easy to begin buying and set up reoccurring times when you will buy the stock routinely, making dollar cost averaging very easy and streamlined. Keep in mind, you can also do this feature with individual stocks that you want to continue buying over time. ETFs require very little requirement for the individual over time, making it very easy to buy and leave it alone for some time. They require some time up front to decide which one you want. Most investors will pursue this type because of its easy and almost automatic way to prepare for their future, and because most individual stock investors will fail to beat the overall market over time. Generally, ETFs are mostly hands-free, but if you plan on investing large amounts of your money into something, having some sort of education on the topic is necessary to protect yourself from people who do not have your best interests and common mistakes that new investors make. ETFs also give a dividend yield, in case you're wondering. The crypto investor. They believe in their currency and see true application and possibility in it that is yet to be fully understood and adopted by the mass society. They're most likely younger and open to newer possibilities than their older counterparts. Cryptocurrency has been around since 2009 and is still considered very volatile, even though some adoption has been made. It has the possibility to increase in price dramatically or decrease rapidly within a short amount of time, as we have seen over the years. Over 2020 to 2022, we have seen a peak, and it is now time for a bear market. Crypto is definitely not for the faint of hearts, because the volatility will shake you out if you are not able to withstand the major losses. Crypto investors are very in tune with the HODL mentality, and they are in it for the long run for the most part. As the fear begins to become real, people will begin to wonder if crypto will ever reach its high again, and if it's worth investing into right now, even though other assets are on sale as well. Invest what you are willing to lose into crypto and be wary of pump and dumps that provide no value but the name itself. Remember to take your crypto off the exchanges and store them into your own digital wallet to ensure that you have full ownership of your crypto and that you won't have to deal with losing all your money because of unreliable companies like FTX. Crypto investing is great and a little exposure is worthwhile, but if you plan on being heavily involved, it is best to be in it for the long haul due to its volatility and uncertainty. As of late 2022, the crypto market has been experiencing a bear market for quite some time now and probably will not go up until we see some positive actions in the stock market. 2023 as of now looks like it's going to be a risk-averse year, but if you're willing to invest into some crypto while everyone else has banned it to the shadow realm, then you could possibly see yourself enjoying a nice profit. A more interesting way of investing, in my opinion, than ETFs is choosing individual stocks that you deem are going to be great companies in the present or in the future. Chances are most of these stocks are already are already in most big ETFs, so you can still contribute to established companies. But instead of some of your money going to assets you do not know about or care to invest in, you can have a little more money to focus on to the ones you truly believe will become a vital company to the world. This will take more research than other methods of investing, but if you want to buy individual stocks, having a good understanding of the company before you buy into it is a smart move. If you decide to embark on this path, just know your efforts might just end up in underperforming the market. As assets continue to go down in price, some will seem more appealing than others, and at this point you can begin focusing your money on a couple of stocks that you have a large amount of conviction in. By focusing your money, you are allowing yourself to be more involved with what you're being possibly leading to greater returns or losses. But on this channel, we want growth, so research and understanding are going to be the focus point on this. If you have money for it, then real estate investing might be just for you, since there are plenty of advantages that come with it. If you're able to find a home and rent other rooms to other people to help pay your mortgage and pay it off completely with some left over, then you are definitely in a good position to be in, due to the fact that most of your living expenses are covered, thereby allowing you to have more money to invest in yourself or into other projects you want to pursue. The drawbacks of this are, of course, the money up front you have to have prior to buying and possibly dealing with bad tenants. But if you're able to save enough to purchase a home that is pretty good condition and rent out to decent tenants, then you'll be fine. Real estate tends to appreciate over time, just like the stock market, but that doesn't mean it can't go down in the short term. It is important to understand your area and what type of characteristics make a property valuable to most people prior to buying your home. The housing is not promised to see a crash within the coming years, and we could possibly see just a small downtrend before prices continue to go up and supplies go down. Interest rates are currently pretty high to what they once were, but as inflation decreases, we will also see lower interest rates as well. I am personally planning to buy a home in my area during 2023, so all I could do at this moment is continue to look at suitable houses and monitor for a downtrend in my market. Finally, the one investment that will yield the highest return in investing in yourself. This can mean reading books on self-improvement, finances, or anything that stimulates your brain. Trying out new things or exploring more into your own interests to help you find who you are and who you want to be in the future. Finding your interests will also allow you to start allocating more time to what you enjoy doing and spend less time on money on stuff you don't find as fulfilling. Establishing goals and plans for those goals is also another way to monitor your improvement and assess your progress towards them. Improving your mental and physical health by having a balanced diet and maintaining a workout routine that you can continually accomplish will greatly improve your overall health, therefore allowing you to live longer and be without extreme illness and ailments for longer, so you can truly explore what the world has to offer. Investing into materials and equipment for your use might seem like a big leap for a small amount of reward, but if you continue to spend time and try to advance your skill and circle of confidence around the subject you are trying to become a professional in, then you are bound to find some success. In other words, don't be afraid to quote-unquote lose your money if things don't work out on the first time. Investing in yourself, just like other investments past, don't make you rich overnight, and you have to be willing to see it through before you could really start to reap the rewards. If you want to start a business and have no idea where to start, then I recommend finding something you are an expert at or something that you have invested copious amounts of time into already, and try to teach others on what you have learned and how to improve. If that doesn't sound like something you could achieve, but you still want to be self-employed, then pursuing a small hands-on business that performs a task that is oftentimes considered burdensome might be up your alley. Whatever your venture is, it must provide a solution to somebody's problem. To bring my video to an end, I want to make clear that these different investment paths are not set in stone, and that most of you will most likely incorporate multiple strategies and truly make it your own. Besides the mattress one, hopefully. Maybe. I don't know. Personal finance is personal, and whatever gives you confidence to continue investing is right for you. Don't let others sway you into their way of thinking without understanding the concepts first. There are more strategies or methods of investing, but these are the ones I wanted to focus on today. If you have enjoyed this video, interact with this video and share with others who might be interested in investing in 2023. I make videos weekly, and if there are topics that you want me to go over, leave a comment. Peace, guys.